whereas the cash which has come after the sale proceeds of RCC, of the FMCG business, was in RCCL. So best form was to do a demerger along with all its assets and liabilities and transfer it into the RCCL so they can knock off the debt between the external debt and the cash sitting in RCCL. So that is number one. As far as the Ray Global Holding is concerned, the Ray Global Holding holds 100% of RCCL. So therefore the value of Ray Global Holding is typically the value of the cash realized or the sale proceeds realized by RCCL, which is to the tune of 2,800 crores, less of taxes, which is around 2,200 crores. The swap ratio has been based on the 2,200 crores, which is the net of tax proceeds and the value of the Raymond Lifestyle business. And that is why the swap ratio has been made, and thereby the increase in the shareholding has moved from 49% to 54.88%.
Sorry to interrupt, sir. I would request Mr. Abhishek Nagaraj to please follow up in the question queue for the follow-up questions. Thank you. The next question is from the line of Kunjal Palan from Sohum Asset Manager. Please go ahead.
Hi, thank you for the opportunity. So I have one question. In slide number 13 of the presentation,
sorry to interrupt, ma'am. Can you please use your handset while speaking?
Hello, is this better?
Yes, ma'am. Thank you.
Yeah. So in slide 13 of the presentation, 30 crores is subtracted as corporate allocable from the segmental EBITDA. So as mentioned, this includes other income and corporate expenses. Can you give a breakup of how much will be the other income portion in this and how much will be the corporate overheads? And going forward, do we expect the corporate overheads to remain at these levels, or do we expect them to go up in the coming years?
So there is no change in whatsoever in the corporate overhead over the last year or so, because all the restructuring or reduction of the rationalization of the cost has been done in the last 2 years back, and we are continuing with the reduced cost. So we are not expecting any significant change in whatsoever in the corporate expenses. And as far as the other income is concerned, if you see in our the SEBI financials, it is clearly highlighted that in the where is it? Yeah, in the other income for the quarter, it is given as 79.6 crores, and for the whole year it stands to 266 crores.
Okay.
Which is primarily also includes some of the income which are relating to the dealer network, because there is a certain charge on interest on account of dealer network which we do and which is considered in the other income because it is a part of the sales business.
Understood. Yeah. Thank you.
Thank you.
Thank you. The next question is from the line of Kaushik Dhani from Abens. Please go ahead.
Thank you for the opportunity and congratulations on a good set of results. Okay, so also, in fact, I'm pleased to see that, this time the presentation has been pretty detailed and actually has solved a few of my queries. I think queries related to textiles, my previous participants have already answered. But I have got a question on the Maine acquisition. I think during the call, Amit said that, there would be probably a demerger of the aerospace and defense business from the JK files. I just wanted to know what sort of revenue profile the aerospace and defense business has, and are the margins really different from the current set of 15.5 sort of margins?
Yeah.
That's my question.
Yeah, no, absolutely. You see, the growth trajectory and the whole metal usage, you see, the auto ancillary business as well as the engineering consumable primarily consumes steel, whereas this business is the high noble alloys like titanium, Inconel and such things. So that is one reason. Plus, this business is more precision and the auto business is more like with large numbers because you are catering to a very different segment. So therefore, we felt that it is appropriate And considering that we have reached a decent scale in both the businesses, so this business of aerospace, which you asked, is in the range of 275 crores as we speak in terms of revenue, and a very, very high growth potential. And obviously the margin profile is significantly higher of this business, is almost in the range of 25%.
Okay. And this 275 crores is pro forma revenues, or these are total revenues?
The aerospace is the total revenue.
Okay, fine. And secondly, with regards to the real estate, I believe in the news media it was said that based on the JDAs and whatever land parcel has, we could have annual revenues to the tune of 3,500 to 4,000 crores over next 5 years. Am I right?
So I will give you the numbers. What I said was, even today in the morning on the channels I said, based on the current bookings, as you see, we have done 2,300 crore worth of pre-sales bookings. Going forward, what I talk about is in the 3 to 4 years, we should be talking about a revenue of 3,500 to 4,000 crores going forward, considering as we scale up more JDA projects like the Mahim and Sion we have signed today, and which will be starting, let's say, somewhere in the range of 15-18 months. So that will add to the further revenue. So that way, we see clear path for us anything between 3,500 to 4,000 crore revenue over the next 4-5 years.
And what sort of debt or external funds could be required for the same?
Actually, as we speak today, we are sitting on a net cash positive in the real estate business, and based on the model which we have, we are not going to procure any land. It is all a JDA-led model, and in the JDA-led model, there is not so much needed in terms of a big, large upfront payment. And since our sales velocity and execution, it is a very, very fast pace, our peak cash requirement does not require a significant amount of debt. So even if you add, at the end of the day, Thane is also generating every year a significant amount of free cash flow. So we should be able to have a very decent leverage ratios in this business.
Any targeted IRR for this?
So we have said very clearly the return on capital employed for this business is 25% for any of the JDA projects which will be taken into.
Okay. Thank you so much and wish you all the best.
Thank you.
Thank you. The next question is in line of Dipesh Agarwal from UTI Asset Management. Please go ahead.
Yeah, good evening, gentlemen. My questions are bookkeeping questions for Amit. Amit, if I see the unallocable expenses adjusted for other income, since there is a sharp increase in other income, there seems to be a significant increase this year. What is attributable to the increase in the unallocable expenses?
No, see, unallocable expenses is basically on account of two things. Some of the advertisement and expenditure we have considered also in the unallocable because it is for the Raymond and distributed all across. So that is one. And some of the parts are also relating to the acquisition and the expenditure which are incurred for the sale of the businesses, like the FMCG business. These are the two businesses.
Okay. So at an EBITDA level, we have an unallocable of almost 270 odd crores. So would this number be remaining in the same range or it will fall?
No, it will reduce further. Going forward, it will reduce further.
And how should we think about the split of this when we go for demerger between, say, lifestyle business and the real estate business?
Yeah, I think we are just on the working this through. I think by the next quarter, we should have that number ready.
Okay. And the other question is, in the presentation, you mentioned a surplus cash of 680 crores. What is that adjustment? Because the working capital of money is some 312 crores. So if we make that adjustment, it doesn't come to.
No. So two things. On Maini acquisition, we were sitting with a 1,500 crore cash. We paid for the 59% acquisition of Maini close to 700 crore. And we assumed also a debt of 300 crores from the Maini's working capital. If you add the two, that would result into a 682 plus, let's say, 1,000 crore. That would result that without the Maini acquisition, it would have been 1,700 crore cash.
Okay. Sure. And lastly, if you can help us understand what could be the extent of impact of ethnics on the apparel margin? Would ethnics be loss-making at the current juncture?
We are looking at a gross margin basis because when you do the advertisement and others, it has both the advertisement cost for the ethnic as well as it has the advertisement cost for other brands like Park Avenue and such things. So therefore, for the gross margin, we are in line with the industry. Below the gross margin, as we continue to open up the stores and everything, EBITDA margin is something which is one does not need to look into. And we are also more focused on the gross margin, that what we are buying the product and selling the product is absolutely appropriate or not.
Okay, sure. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Varun Singh from ICICI Securities. Please go ahead.
Yeah, thank you for the opportunity. So my first question is on the branded apparel business. Sir, what is the SSSG for the quarter and also for the year for us?
Sorry, what is the question, Varun? Can you repeat it? I couldn't hear you.
Sir, what is our same store sales growth number for the EBO revenue in the branded apparel business?
Yeah, so it is in the range of, it is a mid-single digit number, which we have clocked in quarter 4, which I would say within the positive side of the industry. And the numbers within the similar range for the year also.
Okay, sir. Thank you. And sir, my second question is, in the ethnics business, currently what would be our revenue contribution looking like? Meaning that what would be revenue share from the Sherwani as a segment compared to non-Sherwani or even smart ethnics, which is a differentiated proposition for us?
Yeah. So Varun, smart ethnic is just starting out. So as I said, it's a new launch and really would be able to comment on that maybe I would say 6 to 8 months down the line. Regarding Sherwanis, kurtas and other segments, kurtas roughly would contribute to roughly around 40 to 50 odd % of the business. And then the rest would come from the other wedding wear, which is like Sherwanis, Indo-Westerns, etc. Bundis would contribute another maybe roughly.
Sir, sorry, I lost you. Bundis would contribute how much?
Bundis would contribute around 10 odd %. Kurtas would be around 40 to 45 odd %, 40 to 50 in that range. And the rest would come from Sherwanis and Indo-Westerns, the wedding ensemble. And one thing I also want to point out is the kurtas are also used during the wedding wear as well for ceremonies like the haldi, mehndi, etc.
Yeah, understood. And sir, my last question is in the ethnic segment, like how are we doing capital allocation with regards to ATL and BTL spends to build the brand?
So in this segment, there's hardly any BTL if you ask me. Ethnic doesn't see any promotions, any end of season sales, any discounting. So the entire capital allocation is on brand building, which is above the line. So we are investing very heavily behind two things. One is we need to establish the brand ethnics pyramid. So we need to clearly differentiate this as a retail destination brand for ethnic wear, and that is where campaigns are happening and the media is being spent across mass media as well as digital. So these two form the large part of our media budgets. And then the second part of capital allocation, the budgets go behind retail store marketing, because as we are opening more and more new stores, there is very clearly a module that is there on how do we establish new store presence in that catchment for the first 3 to 4 months. So this is where the money goes. BTL is negligible.
Okay, sir, understood. That's it from my side. Sir. Thank you very much and wish you all the best.
Thank you. The next question is from the line of Himanshu Nair from Systematic Group. Please go ahead.
Yeah. Hi, good afternoon, sir, and congratulations on a good performance. The first question would be on the demerger. So you said 9th May is when the NCLT hearing is scheduled. So assuming all goes well there, by when can we expect RCCL to get listed on the exchanges, sir?
I think the way it is progressing, Himanshu, should be end of July, mid-August. That is the time frame which we are looking based on the process. What we have prepared the timeline chart, various approvals and processes which is required is basically a timely process. So we expect July end or mid-August. By that time, in that 2 weeks period, we should be able to get it listed.
Understood. And the second bit is now after consolidating many, we are still left with 700 odd crores of net cash, and the fact that there are no significant CapEx plans and our cash generation should only pick up. So has the management thought about a medium-term capital allocation plan? I mean, between the three large growth vectors that you talk about, how much we'll be allocating to which vector, or what's our thought process there in terms of new inorganic opportunities as well?
See, Himanshu, as we continue, we believe there is a lot of opportunity in each of the businesses. As Sunil talked about, that there are adjacencies in the lifestyle business which we have and which could create a larger opportunity where initially you need to invest money. Like the way you have seen in the ethnic business, we have been able to expand to 114 stores. We are putting money behind the brand. So I think that is one very, very clear thought. Second is the garmenting capex, which we have talked that we are investing 200 crore of garmenting capex, becoming the third largest suit maker in the world. And that is again a very, very revenue accretive and a good opportunity business as India getting China plus one and every other theme. So that is the second thing. As far as engineering business, they are generating cash flows, and we believe there is a consistent, we need to put capex in order to further expand the capacity and also to innovate and bring newer products. And especially in the aerospace and defense, there is a huge opportunity. Today, India stands almost like 1.5% of the total aircraft component supply coming out of India. So there is a big opportunity there where we need to innovate and invest. Not very large, but small investments needs to make in order to create a better opportunity for us. And obviously the real estate, as I said, real estate is generating cash, which is deploying back the cash and putting money into the approval cost for the JDS, which then eventually gets started. And with our sales velocity, let's say 18, 24, 30 months, you again see that whatever the money you have spent starts to release back and gives you cash flow. So I think we have all the three vectors of growth, which requires cash, and we should be adequately deploying there. As far as inorganic, anything interesting, never knew how the mining precision came and it became a significant acquisition and is going to help the business improve all the profitability, revenue, growth, and the valuations of the various businesses to unlock the shareholder value. This is again a great opportunity. So like that, we will be on a lookout, but can't say as of now anything substantial is there.
Understood. And final question, sir, would be on the B2B part of our lifestyle business, the garmenting and high value cotton shirting. Given our product portfolio there, looks like our margins are relatively lower to competition. So are we happy with the margins out there, or where do you see margins heading from that 10-11% range in the medium term for the garmenting and cotton shirting businesses?
Okay, I'll take the question on this. So if you see within the garmenting business, we have actually been consistently improving our margins. They have moved very close to now 10-11% margins. And our current focus is on increasing the revenue of the garmenting business as well as improving.
Ladies and gentlemen, the line for Mr. Jatin has been dropped. Please wait for a moment while we reconnect them. Thank you.
No, and there I think Sunil's line has dropped.
Sunil's line. Okay, let me take that question. No problem. Himanshu, I will take that question. Basically, if you recall, Himanshu, in the past, we were in that 7% zone, and we have moved to closer to double digit now. And I think there is a constant effort. And as you expand these garmenting lines, there's a lot of need for training the tailors and the designers and all these people. Because when we supply to the top brand, they want a perfect suit or a trouser or a shirt. So I think there is a lot of expenditure which goes into the training. So as we continue to expand, you would have that incremental training cost which needs to be incurred in order to be on a better side of the product. So that is one very clearly. As well as high value cotton shirting, you see, the best part is that it is a good product to have in order to get the trends and especially the volumes as we continue to grow the branded shirting business. This is something where we can see opportunistically get a good margin. But we can't expect a 20% margin in a B2B business, what you see in a B2C business. So therefore, these businesses will always be in that mid-teens kind of a margin vis-a-vis the branded textile business, which delivers 20+% margin.
Understood, sir. That's it from me. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Saurabh Gilda from Motilal Oswal. Please go ahead.
Hello, am I audible?
Yes, yes.
Yeah. Hi, I had questions on the real estate business. Congrats on the good sets of numbers. Just wanted to understand your pricing strategy for the Bandra project, because it appears that it's it's quite fairly discount to the micro market. So just wanted to understand how we have priced it. And secondly, during the launch of second tower, have we taken any price hikes? And third, for the overall project level, what is the margin that we are expecting? Thanks. Those are my questions.
So, Saurabh, I don't think that impression is correct that we've launched it at a discount to the micro market. Now, Bandra East is comprising of two micro markets. One is a developed market which is towards BKC, and then when you cross the highway on the other side, that side is still developing. It is not fully developed in that sense. So the pricing over there is in the range of 31, 32, going up to 33,000 rupees. There are players like Shapurji and Rustamji who are active there on that side of the market as well. So we've actually launched at a premium to all these players. So I don't know how you got that impression, because on the other side the difference in pricing is almost 10 to 15,000 rupees. So that is a natural difference in the micro market pricing itself.
Oh, okay. Understood. And any prices in the launch of second tower?
Yeah, so we are on to our third tower now, and very soon we will be launching the fourth one also. So we have already taken one price hike from the launch price.
Okay. Can you quantify it or?
It's 500 rupees price hike we have taken.
Approximately. And at
an average.
Okay. Thank you.
Thank you. The next question is from the line of Sanjay Parekh from Soham Asset Management. Please go ahead.
Yeah, congratulations. So I just wanted to, Mr. Agarwal did say that, we could have a run rate of 3,500 to 4,000 crores per annum in real estate. And considering our margins at 25%, can we say that we will hit the 1,000 crore EBITDA on a yearly basis very soon in real estate?
Yeah, absolutely. I think that is a very clear path. If you see, look, very simple is that if I have made with the project being launched 2,300 crores of a pre-sales booking for the year 23-24 without really having a significant JDA project launched. And that reflects very clearly that over the next 4-5 years, you should be able to get these kind of numbers as we continue. And it is very simple math. We are talking a 10 million square feet if you do under construction, 2 million every year in a delivery between 4 to 5 years of project phase. You are talking in Bombay, nothing is less than 20,000 rupees a square feet. So very comfortably, you can hit a 3,500 to 4,000 crores of a sale.
Sure. And this will be over what time frame? I just missed the time frame.
4 to 5 years.
4 to 5 years is where we would hit a run rate of 4,000 crores.
Yes.
So Sanjay, just to add to what Amit just now said, that if you look at our trajectory, it has been, quite fast-paced growth. But now we've hit a certain size. So going forward, you can expect at least on pre-sales approximately about 18 to 20% growth rate. At least for the next 2 years, you can assume that. So even if you were to extrapolate that, what Amit is saying will automatically happen in 3.5 years.
Surely. Very helpful. Secondly, the engineering business is less understood. So with this merger, how would this look like? Because the areas where you are catering, aerospace, defense, even auto ancillaries on the export potential is huge. So how do we think about this business in 3 years? I'm not getting to numbers, but how big can this become? Can you just guide us, please?
Yeah, sure. No, it is a very attractive and absolutely, as you said, that this is something which we believe with the Make in India theme, it's a great opportunity for the engineering businesses where we can build a large scale business. So just to give you a perspective that the top 15 auto OEMs are covered in one way or the other between Ring plus Aqua, our Raymond business, or Mini Precision, which is the newly acquired business. So that is something, it is very difficult to enter into the top OEMs. Now, since we have already the top 15 OEMs, it helps us in order to move forward and get a larger piece of the business. That's number one. The number two, aerospace and defense, as I mentioned and responded to somebody else, that today India is just about 1 to 1.5% of the global $100 billion aerospace component industry. Now, considering that aspect, India, the way it is grown, whatever opportunity is there, it is very easy for us because we have created a decent base of 275 crores and we are into the engine critical components and not the base. So in those components, what happens is you have once entry made, you can be there for tens of years. So I believe, and then we are also in the EV component, as well as if you see the engineering business is going to be headed by Mr. Gautam Maini, who is going to lead that business overall, and that he has been in this business for more than 40 years. So we got, in a sense, through this acquisition, a top technocrat entrepreneur to run the entire business. So as you said, 3 to 4 years, we have delivered an EBITDA to the tune of 275 crores in 23-24. Easily it could be a larger 450 to 500 crore business over the next 4-5 years.
Thank you very much and best wishes to the whole team.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today's call. I would like to hand the conference over to Mr. Amit Agarwal, Group CFO, for closing comments.
Thank you very much. It was great talking to all of you and look forward talking to you in the next quarter. Thank you.
Thank you.
On behalf of Antique Stock Broking Limited, that concludes this conference. Thank you for joining us and you may now disconnect your lines.